to our Tuesday Q&A. And firstly, happy Australia Day. It's the 26th of January, so Australia Day everywhere, and therefore we're all a bit more casual today. As you probably know from last week, certainly the people that attended, we were going to be covering off one of our clients' questions in a sort of part 2 session, if you like, because our client had many questions rolled into one, and his wealth creation strategy as an expat was to buy one property for around $500,000 each year for 4 years, and then buy something later on in year 5 that he wanted to potentially move into as his future home, which was going to be more expensive. And his questions revolved around this really well thought out strategy. So we're going to cover off the second part of that today. And one of the key issues that came through from these questions from our client was, if we have a look at this, it's the property mix strategy or the portfolio mix strategy. Should I focus on the highest growth possible properties without having to top up each mortgage payment myself? So I look at that and I go, I hear this question from a number of people, and we hear it along the way, and we sort of think, I go, why do people worry about that? Like, seriously. Why wouldn't you just concentrate on trying to get the highest growth quality assets to give you the best possible outcome later on? Because by contributing an insignificant amount of cash yourself to mortgage payments and getting a far better outcome at the other end, surely you'd be better off. And that's basically how life treats us and how things actually are. So then let's look at, let's look at the nitty-gritty, if you like, because people worry about this, and sometimes I think, especially if you're living as an expat, this massive contribution that you may or may not have to make may be the cost of a dinner per month. So let's have a look at it, and I'm going to take an example. Let's say that you were going to buy an investment property for $800,000. And our client said, look, I'm going to put in 20% deposit because that's the normal sort of situation, but as we all know, if you're a client of ours, you can actually have access to an 85% LVR mortgage, so no mortgage insurance included. So I've just put in $120,000 or 15% deposit. $680,000 is a loan that's secured by the investment property. So looking at that, if you're buying a quality asset, we're currently looking at gross rental yields of about 4.5%, $36,000 on that property. I've included other expenses of $8,600, and interest payments at 3% on the 85% loan come to $20,400. So $29,000 of expenses, $36,000 worth of income. It leaves us with a $7,000 surplus. So a long way from having to worry about contributing to meet repayments, we actually have a surplus. And we can utilise that to repay some of the principal if we wanted to. It's our money, so we can do with it as we choose. So important to recognise that, and rather than worrying about having to top up mortgage payments, I mean, good Lord, you're buying an $800,000 investment. If you had to contribute some money towards that, if only putting in 15% deposit, that would kind of make sense. People forget that we're living in a very low interest rate environment, so at the moment it's basically a situation where we can buy an asset like that, create positive cash flow, and go forward to create further assets down the track. So instead of perhaps buying a $500,000 asset, you can buy an $800,000 asset. And you can get a better outcome through higher capital growth on a higher initial sum invested. So if we look at the strategy, and given the fact that this client was wanting to put in 20% on a $500,000 investment, so $100,000, putting in $120,000 is not actually a great deal more, yet you're getting an $800,000 asset as opposed to a $500,000 one. And I think that's the key issue. So if you're going to get 5% growth, let's say, on that asset, it's $40,000 on 800 versus 25%, versus 25,000 on the cheaper asset. The other questions that he had were relating to loan eligibility. So, mortgage eligibility. He's 46 and he's saying, will the bank give me a 25-year loan? And the answer is simple, yes they will. In fact, they'll actually give you a 30-year loan. And then the second part was, well, what happens in 5 years' time? Because my strategy is saying, I then want to go and buy the house that I want to live in. Will they give me a loan then? And the answer is also yes. But the more interesting thing is, like, let's say this client was 10 years older. Let's say it's 56 and then 61. We'd still be able to assist in a pretty similar way, given the banking relationships that we have. But we've also helped a lot of older clients. A lot of our clients who are professionals, especially medicos, tend to work longer these days, unfortunately. So, there's no more retirement at 65, it might be 75. And the situation here comes into play where we always say to people, look, be careful, so take out some insurance. Make sure you have some income protection or trauma insurance to protect yourself if something should go wrong, so you can still meet your repayments until you get better, etc. And then we look at the banking side of things. Now, let's say you are an older person and you're seeking a longer loan term to spread out your repayments in a more acceptable manner. If you have sufficient insurance in place that's guaranteed renewable, and we say to the bank, look, this person wants $2 million, let's say, loans, but they've got over $2 million worth of life insurance. That can give the bank comfort if they can take some kind of lien over that to assist the situation further. So it's all about, finding solutions, as I always say, thinking laterally, and that helps everyone achieve an outcome that they want and still maintains protection for the lender, because, the important thing is that the responsible lending guidelines are still in place, even though legislation is mooted to be passed to remove some of those. Most people have the wrong idea of what that means. The banks are still going to use the same stringent criteria when they assess clients for loan eligibility. It's just that they don't actually then have the onus and proof on them in relation to delving into the information that loan applicants give. It's up to the loan applicant to give truthful information. So then the second part of this question is very important. How closely does the bank assess my income and expenses? Well, the answer is they do it very closely, and it's all about income and expenses. So, make sure you've got that right, because if you look at this, for mortgage eligibility, if the rent that in my mind I'm designing this portfolio, the rent specifically planned to cover the mortgage payments for each property, the bank doesn't actually look at it that way, because everyone's different. So, someone might have the same income of, say, $200,000, but one person may have expenses of $50,000 because a lot of those may be discretionary, and another person may have expenses of $150,000. The rental income from the properties that they choose to buy is identical, but clearly the bank lending proposition is very, very different. So just because you're saying you're going to go out and buy properties where the rent's designed to cover the repayments is not hugely relevant. It will impact your serviceability, certainly if you have a higher rental yield, but it's not going to be a panacea for this. So it doesn't work that way, and please don't think that you can actually plan this out in a very stylized manner, because it doesn't happen that way in real life. If my income and expenses, or if my income versus expenses is not sufficient, would it help if I've got a cash buffer? I make bonuses. Bonuses certainly come into the income calculation, but I've got extra cash, I've got shares that I like to trade, etc., etc. Is that going to help me with the situation? And the answer is unfortunately no. We have a lot of clients who have quite a lot of assets, but they may not have quite a lot of income. So the bank doesn't look at your assets and say, yes, well, you could sell those and pay us the debt. They have to look at it on a serviceability basis. So it is all around income versus expenses. And as we all know, fixed expenses are hard to change. If you're paying rent, the rent is what it is. But if you have discretionary expenditure, and let's face it, most expats spent most of their money, I suppose, on things such as overseas holidays, and they're certainly not happening at the moment, and who knows when that will be happening again, and also other discretionary expenses, going out, eating out, etc. So at the moment that's not a massive impact as it has been, over the course of history, but a lot of those things are actually discretionary. So we can choose what we're going to spend our money on, and if we choose to perhaps spend a little less on some of those entertainment expenses, we will have the extra income to support a greater loan. So it depends on your priorities, depends what you're trying to achieve, but yeah, you can't actually then just create this cash buffer and say, well, look, that's going to help. It may help you in a practical manner, but as far as the bank's concerned, it's not going to help you in achieving a higher loan amount if that's what you're looking for. So I hope that sort of covers some of the little traps that people often fall into, and the little quirks, this whole thing about, oh, I don't want to top up a mortgage payment. I mean, why not? Does it matter? Do you worry about going out on a Friday evening and spending X hundreds of dollars on whatever entertainment you're taking? No, you don't. So don't get too caught up on minutiae or noise, as I call it. Focus on the important things, because this is a wealth creation strategy. So the idea is to, from a macro level, create the greatest form of wealth for yourself, taking perhaps the least amount of risk that you're comfortable with, and doing that in an efficient manner. So that's what we're here for. If you need help with this, like this, we can go through all of these questions for each person, because we all have individual set circumstances, and we can sort of show you and say, well, this might be better for you here, this might be better for you there. But at the end of the day, as you can see from this example that I've created, it's pretty hard at the moment to actually have to top up payments in any respect. I hope that's been of a lot of use to some of you, and some use to many of you. And we'll look at next week's Q&A. May not be on a Tuesday, so everyone will be posted about that. And continue to send in your questions. We've already got lots of good ones, so we're sifting through to see what we can cover off in the next few sessions. And I hope everyone has a great Australia Day wherever they are. Certainly the people in Australia, I think, having a pretty good time, especially if you're in Sydney. I think the weather there is pretty good, although Melbourne's a bit drizzly. But wherever you are, make the most of it, have a great time, and look forward to seeing you at our next Q&A. All the very best.